Welcome to the financial education presentation on taxes. My name is Kristen Short. I'm a second-year PhD student in financial planning, and my assistantship is with the graduate school as part of the graduate financial education program. And the whole point of this program is just to provide free education to graduate students at the University of Georgia in an effort to help increase financial knowledge and decrease stress around finances. So I hope that you'll be able to take a lot away from this presentation about taxes. And if you have any questions following the presentation, you can reach out to us at the Graduate Financial Education Program. So why is it important to understand taxes? I have this meme here. It says, I have no idea how taxes work, and at this point, I'm too afraid to ask. So a lot of us can probably resonate with that meme because once you get to graduate school, you've been working a little bit, maybe you have an assistantship, maybe you came back to grad school from being full-time employed, and you're kind of in this adult phase of life where you think, man, I really should probably know something about taxes at this point. But the reality is a lot of Americans do not understand how taxes work. So you can be comforted by the fact that if you don't understand taxes, you're actually in the majority of the population. Many people don't have a good grasp about how taxes work, but today you will hopefully learn a little bit more about taxes, and what you learn today will allow you to really know more than probably maybe 80–90% of the population knows about taxes. So why is it important to understand taxes? Well, you can utilize taxes as a means to offset the costs of setting aside money for retirement. So you can save in your taxes when you save for retirement. You can offset the cost of education, of healthcare, of childcare, of home ownership. So there's lots of different things that you may spend your money on anyway. And if you understand how taxes work, you can offset those costs by taking advantage of tax benefits related to costs in these areas. Now, there's lots of different types of taxes. There's capital gains tax, income tax, sales tax, payroll tax, foreign tax, unemployment tax, property tax. There's lots of different types of tax. But today we're going to be focusing specifically on income tax. And within income tax, there's both federal and state income tax. And we're going to focus mostly on federal tax today. But you should note that you may live in a state, especially if you live in Georgia, that has a state income tax. So you have to pay taxes every year at the federal level and at the state level. There are some states that don't have state tax. So if you live in Washington State or Texas, and there's a few other states that don't charge any state tax, then you only each year have to file your federal taxes. But in Georgia, again, we do have state tax. So let's just look at a tax scenario. Let's say you're employed and you currently make $38,000. And let's say your boss comes to you and offers you a raise of $2,000. So your new salary would be $40,000. And you're thinking, hey, that's pretty nice, a $2,000 boost to my salary. I should probably take that. But then your friend comes to you and says, oh, no, you should not take a $2,000 raise because since you're currently making $38,000, if you bump up to $40,000 a year, then you're going to bump up into the next tax bracket. And you're like, oh no, that sounds awful. So you go and you look and see what the tax table is for a single person, and you see, well, there you have it. The 12% tax bracket ends at $38,700, and the 22% tax bracket basically begins $1 after that. So if you're earning $40,000, you get bumped into the 22% tax bracket. So now with this information, do you think you should take the $2,000 raise? Well, most people would at this point say absolutely not. You should not take the raise because 22% tax on $40,000 leaves you with a lot less money than 12% tax on $38,000. But that actually is not how our tax brackets work. So that would be flawed logic. and that would not be a good reason to justify not taking the raise. So this is one of the most misunderstood aspects of our tax system, is actually how tax bracket works. So let's walk through what would actually happen in the scenario if you took the raise and you got bumped up into the 22% tax bracket. So this is how tax brackets work. Our tax system is a progressive tax system, and one of the meanings of that is that your income is taxed progressively through the tax bracket system. So everyone starts at the 10% tax bracket. All right, and the first $0 to $9,525 of your income gets taxed at 10%, regardless of whether you make $10,000, $50,000, $100,000. Everyone with income, the first $9,525 of their income gets taxed at 10%. Then whatever amount exceeds $9,525 but is less than $38,700 gets taxed at 12%. Okay, and that amount from that bracket gets added to whatever was accumulated from the 10% bracket. And then if your income's bigger than $38,700, then whatever portion exceeds that up to $82,500 gets taxed at 22% and added to everything that's accumulated from the first two brackets. And then beyond that, if your income's above $82,500, any portion above that and up to $157,500 gets taxed at 24%, and so on and so on. All right, so in our example, the math would look a little like this. So the first $9,525 of your income gets taxed at 10%. Then the next portion up to $38,700 gets taxed at 12%. You add that to whatever your income is above that threshold, so the $40,000 that you're now making minus $38,700. So that determines how far above the 12% cutoff you went into the 22 bracket, and that portion of your income gets taxed at 22%. And then you add each of those up, so the total tax you would pay is $4,739.50. So you will see that this progressive tax results in a much different number than if you were to just say, oh, $40,000 is in the 22% tax bracket, so I'm being taxed, 22% of $40,000. That results in a very different number, $8,800. That's not how the tax bracket would work, right? So you would not be taxed $8,800, you'd be taxed that $4,739. So what this means is it's always worth taking a raise, because that's income that you wouldn't otherwise have, right? Like if you didn't take the income, if you didn't take the $2,000, you would still be taxed, the 10% of $9,525 and the 12% up to $38,000, which was the cap of your salary, and then you'd pay tax on that, and you would just forego the $2,000 of extra income. But by taking the $2,000 of extra income, $700 of that $2,000 gets taxed at 12%, and the remaining $1,300 gets taxed at 22%, but you're still left with a net gain, right? You still have more money than you would have had if you had not taken the raise. So from a tax bracket perspective, it's always financially better to take the raise. And then when you look at the Georgia state tax brackets, it's kind of a similar system where you progress through the tax rates. It's just a lot more condensed and collapsed than the federal bracket. So the top bracket is 6%, and you max out there at $7,000. So the first $7,000 of your income gets progressively taxed at 1%, 2%, 3%, 4%, 5%. Once you are making more than $7,000, the rest of your income just gets taxed at that 6%. So figuring out your taxes is really just a matter of pluses and minuses and a little bit of multiplication here and there, right? So the whole math of tax is basically just adding up all the things you earn from the year, your salary and wages, your investment interest, your capital gains, all the different ways that you earn money, adding that all together, and then basically subtracting from that any deductions you're entitled to, any credits you're entitled to, reducing that number by the tax bracket by multiplying it by a fraction or a percentage, and kind of reducing it back down, and then that's how you get your total tax that you owe. So what we're going to do today is basically walk through what this equation specifically looks like. So the tax equation starts with your total income. From the total income, you get to subtract what are called above the line deductions. What is above the line? Above the line is deductions that occur before calculating your adjusted gross income. And your adjusted gross income is basically a number that's used a lot of times to determine your eligibility for different types of benefits. Those benefits could be various tax benefits, or it might be qualifying for need-based financial aid or a need-based scholarship or a certain discount as a consumer. So your AGI is a number that you want to try and get as low as possible in order to qualify for benefits. And so the way that you could make your AGI significantly lower than your actual income is by taking advantage of as many above the line deductions as possible. So then from that AGI, you get to take out more deductions, and the below the line deductions, or the deductions that come after AGI, are either the standard deduction or itemized deductions. And that brings you to your taxable income. Then your taxable income is what goes into the actual tax bracket to calculate what your tax is. So this is also kind of a big misconception when it comes to taxes, is that people think about their gross income and then they look at the tax brackets and they try and calculate about how much tax they're going to owe. But that's really not an accurate way to calculate or estimate what your taxes are going to be, because the number that goes into the tax bracket isn't your gross income, right? It's your income after above the line deductions and the standard or itemized deductions have been taken away from your income. So the taxable income going into the tax bracket is actually much lower than what your total gross income is. So anyway, we get to this point of the calculation where we've calculated what your tax is. And then you get to take away from that number tax credits. Then there's kind of these miscellaneous other taxes that come into play in a few rare situations, which we won't really cover today. And that gives you your total tax. So basically what I want to do with this presentation is walk through every step of this tax equation and explain to you, how do you arrive at your total income? How do you arrive at your above the line deductions? How do you decide whether you take the standard deduction or the itemized deductions, etc. So we're going to walk through this tax equation, and by doing that, you will get to understand how taxes work. Now, something that is part of the tax equation, but really should be kind of considered an afterthought, is the tax withheld by your employer. So the equation I just showed you, this is the actual tax equation to figure out how much tax you owe. But whenever you work, every paycheck that you earn, a small portion of your paycheck gets withheld and basically sent to the IRS as kind of a savings account towards paying off your taxes. So maybe every paycheck, $200 gets taken out to be withheld for federal taxes. And so throughout the year, you're basically sending money ahead of time to the federal government to help pay for your taxes that you owe in March or April. And then when you get to March and April and you perform this calculation here, you then figure out, okay, what total tax was calculated? And then you get to subtract from that everything you've saved or already paid throughout the year. And if you haven't paid enough throughout the year to cover what your total tax ends up being calculated as, then you're going to owe a little bit to the government. If the amount that you withheld from your paychecks throughout the year is more than what you actually end up owing after calculating your taxes in the spring, that's when you get a refund. All right, so let's start walking through this equation, starting with total income. Taxable income includes things like your wages, salaries, commissions, self-employment income, rental income, stock and bond dividends and interest, savings account interest, capital gains on stock, property, bonds. Scholarships can sometimes be considered taxable income. Assistantship income is taxable income. So I list all these different types of income just to point out any way that you earn money pretty much is considered taxable. The few things that would maybe be considered non-taxable would be gifts that you receive from parents or friends, or inheritances that you receive that have already been paid taxes on. Child support payments are non-taxable income, and then sometimes scholarships can be considered non-taxable. But looking at that first list, that is very encompassing, right? Like if you rent out your apartment as an Airbnb and you earn income from that, that's taxable income. If you are an amazing photographer and you shoot senior portraits for your friends and they pay you, that's taxable income, right? That's self-employment income. You don't have to have a legally registered business to earn self-employment income. If you generate income on your own, then you have self-employment income, and that has to be reported on your taxes. So just want to emphasize that all income, with the exception of those few things, and maybe a handful of other exceptions, all income that you earn, regardless of the source, is taxable. Let's talk a little bit about student income. So any student income that's considered taxable is income that adheres to this definition. So taxable income are amounts received as payments for teaching, research, or other services required as a condition for receiving the scholarship or fellowship grant, i.e. assistantships. So if you're in a teaching assistantship and you perform that labor, and in exchange for it, you get a stipend, that's earned income, that's taxable income, right? Like you'll receive a W-2 for that work. Additionally, any amounts that you use for non-educational expenses, such as room and board, travel, and optional equipment, is considered taxable. Okay, so this kind of is in reference to scholarships. So let's say you receive a scholarship and it just gets deposited into your bank account and you're able to use that scholarship for anything you want. You can use it to pay rent, you could use it to pay your car payment, you could use it to buy a computer, you could use it to pay for food. You have total discretion over the way those funds are used. Then you have to report that scholarship as taxable income. What's considered tax-free are any amounts that are used to pay for tuition and fees required for enrollment or attendance at the educational institution, or for fees, books, supplies, equipment required for courses at the educational institution, i.e. scholarship for student fees. So let's say you get a scholarship, and instead of it just being deposited into your bank account, it gets applied directly to your student account to offset your student fees. So let's say you have $1,000 in student fees, you get a $1,000 scholarship, and it has to go to student fees. That scholarship you do not have to report as taxable income because it was used to pay for tuition or fees required for your enrollment. Those are educational expenses. You didn't have discretion about the way they were spent. They were spent explicitly toward your education, and so it's considered tax-free and you don't have to report that on your taxes. Now, if you received a scholarship and part of it went towards fees, and then the excess of it was deposited into your bank account and you could use it however you want, the portion that went towards the student fees is considered tax-free, and the portion that got deposited into your bank account for use however you wanted to use it, that's considered taxable. So let's review a couple different types of income to determine whether it would be considered taxable or tax-free. So what about your tuition waiver? Your tuition waiver is tax-free. Why? Because it's used to pay for tuition. And remember, amounts paid directly for tuition or fees or expenses required for enrollment are considered tax-free. What about your assistantship stipend? It's taxable. You receive it in exchange for labor, you get a W-2 from the institution, and you can spend it on whatever you want. What about scholarships? So this depends. The portion that pays for required expenses is considered tax-free, and the portion that's used for other expenses that are not educational expenses is subject to tax. What about fellowships and grants? So this also depends. Whatever portion pays for required expenses is tax-free. The portion that's used for other expenses is subject to tax. And there may be some rare circumstances where you don't have to pay taxes on fellowships and grants even when you have the freedom to decide how the money is spent. It just kind of depends on the source of the funds, but generally speaking, the same rules would apply. What about student loans? So this is kind of a trick question. Student loans are not income, so they're not taxed, right? Like you'll have to pay back your student loans, but you don't have to report the amount you're taking out in student loans as income that year because it's not income, it's a debt, right? It's borrowed money, it's not earned income. All right, so we talked about total income. Now let's talk a little bit about above the line deductions. So the first type of above the line deductions are actually more like income exclusions, and these are things that happen within your paycheck, so payroll deductions. So these are things that kind of get deducted from your income before you even see an amount deposited into your bank account. So these would include health insurance premiums, contributions to a 401k, 403b, 457b, or other employer-sponsored retirement accounts. So in 2018, the limit for that was $18,500 a year. In 2019, you can contribute $19,000 a year towards those retirement accounts. Health savings accounts or HSA contributions, the limit in 2019 is $3,500 for a single person. So if you're maxing out your HSA, then that comes out of your gross income as a deduction. Any amounts that you're saving to a flexible spending account, the limit for which is $2,700 in 2019. So all of these payroll deductions are ways that you get to reduce your total income to make your AGI smaller, and they get taken out of your paycheck before you even get your paycheck. These other deductions are deductions that you can choose to take based on the way that you spend your paycheck, right? So these are things that happen after you receive the money, and if you use the money for certain types of expenses, then later when you're filing your taxes, you can list those expenses as deductions. So these things would include contributions that you make to a traditional IRA. So if you get a paycheck each month for $2,000 and you send, 100 of that $2,000 to a traditional IRA, and you do that every month for a year, then over the course of a year, you will have saved $1,200 to a traditional IRA. And when you're filing your taxes, there will be a section where you can write out any deductions you qualify for, and you would get to put $1,200 on the IRA line and basically subtract that $1,200 from your income in order to reduce your AGI. All right, so the maximum contribution in 2019 for an IRA is $6,000. And then any interest that you've paid on your student loan up to $2,500 can also be counted as a deduction on your taxes. Educator expenses up to $250 can be counted as a deduction. And then any tuition and fees that you've paid up to $4,000 can be counted as a deduction. So if you look at this, let's say you had an income of $50,000, and let's say each year you paid $2,000 in health insurance premiums. That brings your income down to $48,000. And then let's say that you contribute $8,000 into retirement savings. So that brings down your income to $40,000. And then let's say you contribute $2,000 to a health savings account. That brings it down to $38,000. And then you get your paycheck, and throughout the year you contribute $1,200 to an IRA. So that brings that $38,000 down to $36,800, right? And then let's say you had $800 of student loan interest, and now you're down to $36,000. And then let's say you had $4,000 of tuition and fees, that brings your income down to $32,000, right? So even though you started with this total income of $50,000, your adjusted gross income only ends up being $32,000, right? So that's the process of taking advantage of deductions, because it allows you to kind of reduce down that adjusted gross income, and then by having a lower number for your AGI, it may then allow you to qualify for other tax benefits like certain tax credits, or it might prevent you from phasing out of eligibility for certain tax deductions, or might help you to qualify for a need-based scholarship. So that's kind of how you reduce down your income to get a lower AGI. So the adjusted gross income, I've kind of emphasized and highlighted how this is important, but let me give you some specific examples for why it can be helpful to have a low adjusted gross income. One, AGI is used to determine eligibility for certain deductions and credits. So there's phase-out thresholds, income phase-out thresholds to qualify for certain deductions and credits. So you want to be able to get your income low enough to not phase out of eligibility for those. And those include things like the student loan interest deduction, various education credits like the American Opportunity and Lifetime Learning Credit, the mortgage interest deduction, the charitable contribution deduction, the medical expense deduction can all be impacted by your AGI. And then number two, to determine eligibility for contributing to certain retirement accounts. So there's a retirement account called a Roth IRA. And if you have a certain amount of income, then you can no longer be eligible to contribute to a Roth. And then, like I've mentioned before, to determine your FAFSA loan eligibility. So if your AGI is lower, you're more likely to qualify for FAFSA student loan financial aid. It's also used to determine eligibility for need-based scholarships. Talked about that a little bit. And then in retirement, your AGI is used to determine how much of your Social Security benefit is taxed. So we've talked about total income, talked about all the ways you can deduct from that income to get to your adjusted gross income. And now we get to this kind of below the line deduction, which is either the standard deduction or itemized deductions. So earlier I had said that tax brackets is one of the most misunderstood aspects of the tax system. I would say one of the other most misunderstood aspects of the tax system would be the whole concept of the standard deduction versus itemized deductions. So the standard deduction in 2018, and there will be new numbers when we file for taxes in 2019, but the 2018 standard deduction for a single person was $12,000. For married filing jointly was $24,000. For married filing separately was $12,000 per person. And for head of household, which is basically single with dependent children, was $18,000. So if you take the standard deduction and you're single, just right off the bat, you get to subtract $12,000 from your AGI. Totally free deduction. You don't have to do anything to earn it. You just get it. You're entitled to take off $12,000 of your income before you calculate your tax. If you're married filing jointly, you just automatically get to subtract $24,000 from your income before you apply the tax bracket, right? So it's pretty good deal. Now, itemized deductions include taking deductions for things like medical expenses, taking a deduction for the amount of state and local taxes you had to pay that year, taking a deduction for interest that you've paid on your home mortgage, taking a deduction for any charitable donations that you've made, taking a deduction for any losses that you've incurred to property due to a federally declared disaster. And basically, you can sum up all these different deductions and subtract those from your AGI. But here's the deal. You can only pick either the standard deduction or itemizing your deductions. So it would only ever make sense to itemize your deductions if the amount of itemized deductions you have exceeds the amount you could get just for free from the standard deduction, right? So if you're married filing jointly, your standard deduction is $24,000. So you would have to have at least and more than $24,000 in medical expenses plus state and local taxes plus home mortgage interest plus charitable donations, etc., in order to even make it worth itemizing your deductions, because if the sum of all those itemized deductions only comes out to $10,000, you would much rather take the standard deduction and subtract $24,000 from your income than itemize your deductions and only take $10,000 from your income, right? So a lot of people don't really understand this concept, and when they're at some charitable event, they hear someone say, yeah, please make a donation of $100 to our charitable organization, and your donation is 100% tax deductible. Well, that might be true for some people if they're itemizing their deductions, but if the only charitable contribution you made that year was $100 and you don't have a lot of medical expenses and you don't have home mortgage interest and you weren't part of a federally declared disaster, chances are you're not even going to itemize your deductions because it's going to be way more beneficial for you to take the standard deduction. So really, that $100 that you gifted to the charitable organization, it's really not tax deductible for you, right? Because you're not going to end up itemizing your deductions. So this is just misunderstood a lot. A lot of people think, oh, I'll buy a house so I can at least, deduct the mortgage interest. Well, only if the amount of mortgage interest you pay exceeds what you would get from the standard deduction, right? So again, you should only itemize deductions if the amount is more than what you would claim through the standard deduction. All right, tax brackets. So we already talked a little bit about tax brackets, but I just want to show you that the tax brackets differ, the numbers differ based on whether you're filing single, married filing jointly, married filing separately, or head of household. Actually, the brackets are the same for single and married filing separately, but married filing jointly and head of household are different. So, logistically, the way that you progress through the brackets works the exact same way. The numbers are just adjusted for the fact that, for married filing jointly, you're trying to support a bigger household with the income you do have. And so the tax brackets are a little more spread out and you get a little more of a tax break by being married. So in terms of the tax equation, we're basically at that point. We got to our taxable income after we took off our standard deduction, and then we take that taxable income, we put it through the tax bracket, and that gets us to our tax. All right, so just looking at our equation over here, we got to the tax, and now we reach tax credits. So let me just say, tax credits in general are more valuable than tax deductions. So let's walk through some of the math behind tax credits and tax deductions so that you can see what I mean by tax credits being more valuable than tax deductions. So with deductions, let's say you had $1,000 of income and you had a $100 deduction. Your taxable income would be $900. That taxable income would be put through the tax bracket, so it would be in the 10% tax bracket. 10% of $900 is $90, so you would owe $90 of tax. If you didn't have the deduction, you would have had $1,000 of income, and then that income would have been put through the 10% tax bracket, and you would have owed $100 in tax, right? So by taking a $100 deduction, your $100 of tax got reduced to $90 of tax. So a $100 deduction reduced your tax by $10. Or another way you could say it is a $100 deduction reduced your tax by 10%, $10. And the reason why it reduced your tax by 10% is because your income was within the 10% tax bracket. All right, now that's a little confusing, but let's jump to credits. So let's say you had $1,000 of income. And that income got put through the tax bracket of 10%, because let's say you didn't have any deduction. So you'd owe $100 in tax. And then let's say instead of a $100 deduction, you had a $100 tax credit. That tax credit would be applied after your tax has been calculated. So you'd get to minus the $100 credit, and the actual amount of tax you owe would be $0. Right? So tax credits reduce your tax liability, or the amount of tax you owe, dollar for dollar. A $100 credit reduces the tax you owe by $100. Whereas deductions reduce the tax owed by the percentage of your tax bracket. So for every $1 of deduction you have, if you're in the 10% tax bracket, your tax gets reduced by basically 10 cents. So for every dollar, your tax gets reduced by 10 cents. You have a $100 deduction. Overall, your tax ends up getting reduced by $10, hence the $90 owed. So if you had the choice between a $100 tax deduction or a $100 tax credit, you would always want to take the $100 tax credit because it reduces your tax dollar for dollar. So there's two types of tax credits, refundable and non-refundable. And refundable tax credits reduce your tax liability, or the amount of tax you owe, below zero and allow you to receive a tax refund. So let's say you had $2,000 in tax that you owed, and let's say you qualified for a $3,000 refundable tax credit. That $3,000 would reduce your tax from $2,000 to $0, and then the extra $1,000 left from the refundable tax credit would actually get given to you as a refund from the IRS. Whereas a non-refundable tax credit reduces your tax liability to zero, but they do not allow you to receive a tax refund. So if you had a $2,000 tax and you had $3,000 in non-refundable tax credit, you wouldn't get any kind of refund. That $3,000 would just reduce your tax to zero, and then the extra $1,000 of the credit that you didn't get to use, it would just kind of disappear. So tax credits are better than tax deductions, and refundable tax credits are better than non-refundable tax credits. So just to go through a couple of the tax credits that could apply to you, the lifetime learning credit is a credit for people who are in school who have already completed their 4 years of undergraduate education, and it's a credit for 20% of the first $10,000 of tuition, fees, books paid out of pocket. So let's say you spent $10,000 in tuition, 20% of $10,000 is $2,000, so you would be able to take a non-refundable credit of $2,000. If you only spent $1,000 in tuition, then 20% of $1,000 is $200. You would get a $200 tax credit, non-refundable. And notice that this credit has an AGI phase out. So if your AGI is too high, then you no longer are eligible to take this credit. So it just emphasizes again the importance of those above the line deductions to get your AGI as low as possible to make sure you can qualify for some of these later tax benefits. Then there's two credits related to children and dependents. So the child tax credit is up to $2,000 in credit per child. That's just for having a kid. You get to subtract $2,000 from your tax liability. It's partially refundable, which means up to $1,400 of it can be refunded. The child and dependent care credit, basically if both spouses in the household are either working full-time or are full-time students, then they can qualify for some credit for any dependent care that they have to pay for children or a qualifying person, which could be an aging parent or something. So if you're having to send your kids to daycare because you and your spouse are both in school or you and your spouse are both working, then up to $3,000 for one child and up to $6,000 for two children or qualifying persons can be used towards calculating the dependent care credit. And then the earned income credit is a credit that basically helps redistribute funds to low income families. So you have to be at least 25 years old to be eligible for this credit, but it's a refundable credit that puts money back in the pocket of low income earners. So you could receive as much as $6,431 in tax refund, just like that, not pay anything in taxes and get $6,000 back just by qualifying for this credit. And then there's something called the retirement savings credit or savers credit. To be eligible, you can't be a full-time student, and there's also an income phase out, but as long as you're not a full-time student and you're under the income phase out, then any contributions that you make to a qualified retirement account, whether that's through your employer or contributions you make to an IRA, you can basically add up all those contributions and then calculate according to the credit calculation up to $1,000 in credit, non-refundable against your taxes. All right, so we've made it through the basic tax equation. Then, as I mentioned before, you get to look at how much you've withheld in your paychecks, or basically how much you've saved up for your taxes up until tax season, to determine whether or not you've undersaved or oversaved, and whether you need to pay off the remaining balance of your taxes, or whether you're going to get a refund or basically some of your savings back. So this is how tax withholding works. So basically, the employer withholds money from your paycheck. That money is given to the IRS. And then if the amount of money they took out is more than your total tax, you get a refund. If the amount of money they took out is less than your total tax, then you owe money. And the catch is, you can control how much is taken out of your paycheck, right? So if you like getting a refund every year, you can overpay your taxes through your withholdings, and then you'll get a refund. If you don't want to be over withholding and you want to have as much money in your paycheck as possible, then you can reduce the amount that's being withheld in your paycheck, and then you just need to make sure that you're saving up, or you have the ability to pay whatever taxes you owe in the spring. So whenever you start working for an employer, they'll give you a form called the W-4, and this form allows you to claim a number of allowances that then determines how much money gets withheld from your paycheck. So it's a fairly simple form, but it's accompanied by a worksheet that is incredibly confusing. And so a lot of people think that withholdings and allowances is a very, very complex, confusing process, and it kind of is, but it doesn't have to be. And so really, all you need to fill out on this sheet is your personal information and basically the number on line 5. So the total number of allowances you're claiming. That number could be 0, 1, 2, 3, 4, 5. Theoretically, you could claim 10. Like, that number can be anything you want it to be. And the accompanying worksheets that come with the W-4 are just to help you make a best guess about what that number should be, but you don't have to use the worksheet. You can just pick whatever number you want to be in that box 5. Okay, so what do those different numbers mean? The way our tax system works is that the larger a household, the less tax that household will have to pay on the same income that a single person would make. So let's say you have a single person making $50,000, and then you have a married couple with 2 children, so a household of 4, making $50,000. The amount of tax that the single person earning $50,000 is going to have to pay is a lot more than the amount of tax that the household of 4 making $50,000 is going to have to pay. The IRS is going to give tax deductions, tax credits, tax benefits, all these different types of ways, a better tax bracket that will make it so the family of 4 pays less tax on $50,000, because that $50,000 is going to have to support 4 people rather than just the one person in the single household, right? So whenever you claim allowances on your W-4, you're kind of communicating to the IRS how many people are in your household so that they can estimate how much they should be withholding from your paychecks to most closely estimate what amount of taxes you're going to have to pay on your income, right? So if you put 0, that basically tells the IRS, I have a really small household. So if you're earning $50,000 and you have a really small household, you're going to end up having to pay more tax. So basically, the employer is going to withhold a larger amount of money from your paycheck each paycheck to make sure that you have the money saved to pay your taxes in the spring. If you put 1 allowance or 2 allowances or 3 allowances, let's say 3 allowances, that communicates to the IRS, I have a pretty big family, and so when it comes to tax time, I'm not going to have to pay as much on $50,000 as a single person, so you can actually withhold a little bit less from my paycheck from month to month. So when it comes to claiming allowances, think about it this way: the more allowances you claim signals to the IRS you have a bigger family, which means your taxes are going to be lower. So they take less out of your paycheck, which means you get a bigger paycheck, right? So you can kind of think more allowances, bigger paycheck. So if you're confident you can save for your taxes or pay for your taxes out of a savings account or something in the spring, and you just want your paycheck to be as big as possible, you can claim 3 allowances even though you're a single person, or 2 allowances even though you're a single person. And that will make your paycheck bigger because they're going to withhold less from your paycheck. You could also claim 0 even if you're a family of 4. They're going to take out a lot more from your paycheck, and then when you get to tax time, you'll probably get a refund. All right, so we've walked through the whole tax equation. How do you actually file your taxes? There's a few different filing forms. There's the 1040-EZ, which is basically a simplified version of the 1040. The 1040 is the main tax form that kind of walks you through the tax equation. And then there's something called the 1040-NR, and this is used for non-residents. So likely you'll use one of these 3 forms. So here's just what the 1040 looks like. So the first section is just personal information, information about your household, and your signature, occupation, stuff like that. It's just personal information. Then the second page looks like this. So you'll see lines 1 through 6 is basically adding up all of your income, right? Income from wages, income from interest, income from dividends, income from payouts from your retirement accounts, Social Security benefits, and then any other income that you've reported on Schedule 1, which is a separate form that helps just break down the income category even further. And so you kind of add up all your total income, you put it on line 6. Then line 7 is your adjusted gross income. So if you remember from our tax equation, what happens between total income and adjusted gross income, you're above the line deductions, right? So it says, if you have no adjustments to income, enter the amount from line 6. Otherwise, subtract Schedule 1, line 36 from line 6. So that just means that on Schedule 1, which is that separate form, it's going to list out boxes for all the different types of above the line deductions you could take. And if you have those deductions, it's going to total them up on that Schedule 1. And then you get to subtract those from the total income in line 6 to get to your AGI in line 7. If you don't have any deductions, then whatever you totaled up from line 6 is just going to be the same as your AGI in line 7. Okay, and then if you think through our tax equation, what comes after adjusted gross income, you get to subtract either the standard deduction or itemized deductions. All right, so if you choose to itemize your deductions, you have to list them all out on Schedule A. But otherwise, if you're taking the standard deduction, you just write the $24,000 or $12,000, whichever filing status you are, or $18,000 if you're head of household, on line 8, and you get to subtract that. Then there's kind of this qualified business income deduction, which we won't focus on today, that you'd also get to deduct if you're self-employed. And then line 10, you get to your taxable income. Then you'll see line 11A is where you would calculate your tax. And then there's kind of like some alternate taxes for more rare scenarios that you might have to add to that. And then you get to line 12, 12A, where you get to take the child tax credit, or 12B, where Schedule 3 comes into play, and Schedule 3 would list out all the other different types of credits that you may get to claim. You get to sum all those up, put them on line 12. Those are all of your tax credits. And you get to subtract those tax credits from the tax amount you calculated in line 11. All right, so then there's kind of the other taxes I mentioned we won't talk about, but basically that gives you down to line 15, your total tax. And then from there, you get to figure out how much you've withheld on your taxes throughout the year to determine whether or not you've overpaid or underpaid, and whether you get a refund or whether you owe money. So how do you actually file? One option is you can go through a Volunteer Income Tax Assistance Program, or VITA. There's one available through UGA, through the Financial Planning Department, and they partner up with Georgia United Credit Union to offer free tax filing. So if you want to get your taxes filed for free, you just go to that website, schedule an appointment, and work with VITA to get your taxes filed. If you don't want to do that, you can find a preparer at H&R Block or United Way or some other tax service. And if you're under a certain income threshold, you may be able to do that for free. Otherwise, you have to pay based on the number of forms that you're required to fill out. You could use online software via Free File Alliance, which is accessible on the IRS website. Or you could use commercial software like TurboTax or TaxAct. Or you could personally prepare paper or digital forms. So on the IRS site, there's an e-file link where you can just pull up a digital copy of the 1040, walk through it, filling out all of your numbers, and then you could submit that as a file. So what I would recommend if it's your first year filing your taxes and you want to try and file them by yourselves is I would just prepare paper copies or download the PDF from the internet and prepare a 1040 on your own, and then go to somewhere like VITA or find a preparer or something and have them prepare them, and then check your work against what they come up with. If you do well, then the next year, maybe you just go ahead and file by yourself. So here's just some other resources. Again, the VITA program. Whenever you have questions about tax, you always want to go to a reliable source. So the IRS website is a good place where there's a lot of instruction packets and publications that detail different rules about taxes. And then the Aspire Clinic, they don't necessarily file taxes, but they could do tax planning with you. So if you wanted to strategize how you could reduce the amount of taxes that you owe, if you want to take advantage of more tax credits or more deductions, or you want to decide whether you should take deduction versus the credit, you can kind of run all of that by a financial counselor at the Aspire Clinic, and that's just free one-on-one financial counseling. So that's always an option for you, and that's on campus. You can just reach out to them via email or that phone number there. All right, so that's all I have for you with taxes. Hopefully you learned something new that you didn't know before, and I guarantee if you walk away with even anything from this presentation, you will already know more than most of your peers do about taxes, and you'll be just a lot more prepared to make decisions to help reduce your taxes and just make the most of the dollars coming into your paycheck. So if you have any questions, you can reach out to us at that email address there. It's gradfineduc@uga.edu.